Hello and welcome to the latest Retire Well episode with me, Matthew. And as always, I'm joined by Joe. Today, we're going to go through a lot of frequently asked questions. We've had some great questions from listeners in the comments. So we're going to go through some of those questions and unpick stories and ideas so we can help people going forward.
Yeah, absolutely. I mean, as Matthew said, we do get a lot and sometimes we do try and answer them down in the comments, but I think some of them are justified to have a little bit more of a lengthier chat around the podcast. So if there are anything that's sort of triggered from this episode where you'd like to ask a question in the future, put them down below or give us an email at retirewell@wealthadvice and we'll store them up and we'll do a future questions episode in the future as well. But to start off with, Matthew, I thought there's a couple of questions on tax-free cash, which is always a common question when you're coming up to retirement. And one question was actually with regards to one of your explanations with regards to the two different taps that you can have at retirement. And they essentially asked sort of, can I choose to draw down from the taxable portion and leave tax-free cash in place so that tax-free cash remains invested and the portion of the tax-free cash increases while only drawing on the taxable portion of the pension?
Definitely. So as people who've watched a few episodes will have heard me talk about the taps. And in general, I think about a tax-free cash tap and a taxable income tap. So what you can do, most people understand that you can have a 75% taxable income and a 25% tax-free cash. Sometimes there's confusion over whether you have to take that straight away, the tax-free cash. And we rightly tell people that, with a modern pension, you should be able to leave that tax-free cash in a pension and drip feed it from that tap. So what you can do is you can take tax-free cash only to meet your income need, or you can take some tax-free cash and taxable income. But what you can't do is only take taxable income. You can't only turn that tap on unless you've already crystallized some of your pension. Crystallization is some jargon, but essentially it means you've already accessed some of your tax-free cash. So you've already almost released a bit of tax-free cash to then be able to turn on that taxable income tap. What we tend to say to people is the key bit for them to think about is what's the actual level of income they want to drop into their bank account. And then we can think with the different taps available, which might not just be pensions, it might be an ISA, an offshore bond, a personal portfolio, plus the taxable and the tax-free tap. Easy for me to say.
Yeah, I mean, I think with that one, I similar to taps, I like to think of it in buckets, I suppose, and maybe it's just another household implement trying to justify what's within a pension. But yeah, in order for you to sort of draw down 750 taxable income, you need to crystallise £1,000 worth of pension, which means for you to have that taxable income to bring out, you have to take that tax-free cash out before you can access the taxable income. I think that's probably the easiest way to look at it, and you can't just straight away take all that taxable income without touching the tax-free cash at all.
Yeah, definitely. People who are really sort of tax efficient with their mindset might say, okay, I'm going to use my personal allowance and I want to take that just from taxable income. Well, like you described there, you can't do that unless you've already released that tax-free cash, which you might have already taken as a lump sum, that's fine, or you might have to take as part of that transaction. So that's the balance of trying to be tax efficient, but also to use the right tap at the right time.
Yeah, you've almost answered the next question then before we even got to it. It's actually with regards to sort of personal allowance. So once we've established that we've got that sort of tax-free element and taxable element, and it might be the case that we've crystallised enough of that pension, taken enough tax-free cash that we've then maybe only got taxable income left within the pension. And this commenter is essentially asking, if you were to only take 12,570 out of your pension each year in taxable income, can you essentially not pay any tax at all, even though you're not accessing your tax-free cash?
Yeah, 100%. That is taxable income, but at a rate of 0%. So I think most people know that they've got the allowances available and they can draw that bit. But it's funny because you then get almost like a pay slip which says taxable income, and so well, hang on a second, it's not taxable. That's because they've got the allowances available. One addition to that is, if you've got a married couple and the spouse isn't earning more than the personal allowance, there might be the ability to transfer 10% of their personal allowance across, so they might actually be able to take 10% more than that personal allowance. Moving on to think about the annual allowance, we've had a question here where someone says, if I'm retired and I was then downsizing and from releasing some capital from that, could I then put £60,000 into my pension, providing that pension was not already crystallised? And would you get any tax relief on that?
Yeah, so there's a few bits, I suppose, to pick out of this one, and it's not just a simple question. I mean, he's identified there that annual allowance is currently 60,000, which is the maximum amount that you can put in any one tax year. Mentioned that the pension isn't crystallised at the moment, so he's not restricted to the money purchase annual allowance, which is £10,000, which again, that's 2 ticks in the box, and it might be, oh, great, let's look at contributing that 60,000. The issue here, if he's retired and doesn't have any relevant UK earnings, then you can only contribute up to that minimum amount that we've spoken about on a few podcasts, which is £2,880 grossed up by 720, so 3,600 that you can contribute to a pension in any one tax year if you don't have any earnings. And that applies to anyone. If you're retired or if you're a child, you have that allowance available. So in this case, you might be limited to that amount. If you do have relevant earnings, and relevant earnings in the simplest form, it's sort of employed or self-employed income. Dividends doesn't count. Property income doesn't count to those earnings. So if you had a buy-to-let and you had some income coming in there, that doesn't contribute to the amount that you can add into a pension each year. So I'd say with regards to this one, you could look at contributing that 2,880, get 720 tax relief to 3,600, and then with the rest of the downsize lump sum that you might have received, then you're probably going to have to be looking at other alternatives. That might be, if you're a couple, you could look at sort of, if the other spouse is working, looking at direct towards them. Maybe look at filling up your ISAs, or outside of that, maybe a bond or a general investment account to try and build that up.
Yeah, and then just to shine a light on one area of good, planning is the tax year when someone finishes. That might be their last opportunity to put more money into a pension. So again, if someone's earned £40,000 or £50,000 in the tax year and then they're finishing, that is their opportunity for them to say, well, what have I got in cash? What am I releasing from potentially downsizing? Am I willing to put that into a pension now to bank the tax relief, knowing that my tax relief is going to be limited going forward? And I think it's not always that thought through. Again, downsizing can always be something that comes later into retirement. So again, using ISAs and things like that can be perfect.
Yeah, I mean, building on that as well, that's where we've spoke about previously, when we're looking at transitioning into retirement and looking at sort of moving from spending someone else's money in your salary to spending your own money. That can be a case where if you do have excess cash, and it doesn't have to come from a property downsize, it could come from almost just built up savings in sort of cash savings from when you've been working. You could then look at sort of setting that year before retirement of living off those savings, and then potentially look at salary sacrificing or contributing to a pension during that year to really maximise your pension contributions in that last year, be tax efficient, whilst in the same vein getting used to spending sort of a set lump of money as opposed to something that comes in regularly each year.
Yeah, I love that approach, because I think that gets you, ready in terms of the income that you think you'll spend, but it also puts more, if you're climbing the mountain, accumulating funds, you've got higher on that mountain to then start that safety accumulation and start that descent. So I love that idea of, one, being ready for how much you'll spend, but two, squeezing the tax efficiency out of your pot, definitely. So another question we've had here is to say, if I've only taken income within my personal allowance from a pension, have I still triggered the money purchase annual allowance?
Yeah, it's a good question. When we always explain the money purchase annual allowance, it's not a trap, but some people can fall into it without realising. We essentially say if you take 1 penny of taxable income from your pension, you've essentially triggered that, and you'll start to be limited to that £10,000. And we have just answered a couple of questions ago that you can take taxable income without paying tax. That's not the case with the money purchase annual allowance. As soon as you essentially crystallise that pension and take a penny of what could be taxable income, that's when it gets triggered. It's not sort of at the point of taxation where that money purchase annual allowance could be triggered.
Yeah, I mean, I suppose technically from the textbook, it's taxable income, but the tax rate 0%. So again, it's taxable rather than tax-free cash, which is completely tax-free. So yeah, to answer that question, it would be Someone could accidentally trigger the money purchase and allowance if they got that wrong. So it's definitely a key point to clarify as you've done there.
Yeah, and I think that's maybe a good point, just to reiterate some of the ways which you may not need to trigger the money purchase and allowance. A lot of the time when it's sort of accidentally triggered is when it's a smaller pension pot, and people will essentially say, oh, well, it's only small, it doesn't really matter, let's just take it all as a lump sum, we'll get our 25% tax-free and 75% taxable, and we'll be done with it. And that's when in the past we've come into an issue where if you do then in the future want to make large pension contributions, but you may have done that 5 or 10 years ago, that's when you are limited to that sort of £10,000. So something that you could look as an alternative is just make sure that when you are taking a small pot like that, see if it's eligible for what's called a small pots allowance, where you can take up to £10,000 3 times. And if you do it that way, even though you are taking a taxable income or lump sum, it doesn't actually trigger that money purchase annual allowance. So that's something that I don't think many people will be aware of. And it's worth asking when you're speaking to your pension providers if it's available, if you qualify, and essentially if you can take some taxable income without triggering that allowance.
Yeah, and I think the bit that you've highlighted there is, it's the jargon again. Technically, the small pots means something. Again, someone might just think, oh, well, I've got a small pot, so therefore I'll cash it in. Really taking it by the small pots rules is the important bit, so you haven't triggered the money purchase annual allowance. Again, if anyone's watching this and they're talking about the money purchase annual allowance, I don't understand what that is. We've covered it in other episodes, but it's essentially severely restricting the amount of money you can put into a pension going forward.
Yeah, exactly. So moving away from pensions slightly and moving on to more sort of looking at inheritance tax and how that may sort of be implicated maybe later on in your retirement. So we've had a question here from a commenter and it says, if my father owns a house and it's worth, say, £350,000, once he passes away, it will go directly to his mother, or sorry, will it go directly to his mother automatically? And then if his mother passes away, does it go to the children automatically with no tax? So this, I suppose, is a little bit of a question to ownership of property and then also those inheritance tax thresholds that we spoke about previously.
Yeah, so I think the simple answer in terms of will it be automatic depends on how it's set up. Again, what's written into a will and how that property's owned. In terms of a property ownership, if you have a married couple, you could be owned as joint tenants or tenants in common. Joint tenants essentially means that if one person passes away, it does automatically go to the other person. So in that question, the answer would be yes. If it's tenants in common, technically you've got a line down the middle and you own 50-50 or a percentage share each, and that will would determine where they go. So we can't clearly answer that question without knowing a little bit more about the legal ownership. But for the majority of people, it is joint tenants. And when one person passes away, the other person inherits the full amount. In terms of then, if the surviving spouse then passes away, will it automatically go to the children with no tax? Well, again, that would very much be dependent on the will and how it's set up. But we know we've got the residential nil rates band available to pass on additional funds. So if the 350,000 was the main asset that this couple had, and they only had a small amount of sort of chattels and cash, say they still had 500,000 in total, then that could go on first death there'd be no tax because there's no inheritance tax between spouse, and on second death, if it was passed to children, it would be within those IHT thresholds and there would be no tax to pay again.
Yeah, and with that as well, when it looks at sort of moving it along and moving it over, the surviving spouse would inherit any unused allowances that sort of your father might not have used. If your father did look at gifting away other stuff on death, for example, a couple of 100,000 to someone that isn't your mother and wouldn't directly go over without any inheritance tax, that might have some implications to what tax will be paid on second death. But yeah, as Matthew said, without knowing more details on this, it's quite hard. But if it's left to a direct descendant, then yes, you could look at getting that residency nil rate band, I believe.
And just picking up at this again as a planning opportunity, we work quite closely with solicitors. And one of the points there is, joint tenancy is the automatic thing that when people buy a house, that's what they have. But from an IHT point of view and from a planning point of view, thinking about care home fees and other things, actually severing that tenancy and having your half in the will left to the next generation on first death can then mean that essentially a surviving spouse only owns half a property. So then if they did end up needing care home fees in the future, they've only got half a property to be assessed against that. So again, everyone's, circumstances are unique, and we can't give broad brush approaches. But I think, when people are thinking about, can I leave assets efficiently and can I think about protecting for the next generation, that severing the tenancy and having that written into your will can be a really, really good way of thinking about it.
Yeah, I think when it comes to estate planning and inheritance tax in general, that is definitely one where you should speak to an advisor, a professional, a solicitor, because I've seen it go really, really well, and you can save lots and lots of money from inheritance tax if it's planned correctly. But equally on the flip side, I've seen it go quite wrong when maybe something has been planned in the best possible mind, and the plan is to create a better scenario, but because there's a couple of bit of intricacies where you haven't followed the process correctly, you can fall flat and maybe not make those gifts as you were wanting to.
Yeah, and I think we've seen a few DIY IHT plans recently that have possibly missed some of the options available to them, and some of the gifts, some of how to structure things, the death benefits with pensions and other things. And actually the tax implications there have been to create more tax for the family. So again, that individual probably thought financial advice could be expensive, so I'm going to try and do it myself, and therefore I've had an immediate saving. But actually quite quickly, a professional advisor would have added a lot of value. So I often say to people in that situation, just have a second opinion, have the conversation. Again, go in with an open mind, and you might be interested to see where we go. I recently had a client who, with the change in pension rules, said, okay, we had money that was going to be left in a pension and that was going to be outside of our estate. Now that's pulling into the system. That really changes the IHT position. And they were quite impressed with the ability for us to set up some life insurance, make some gifts into trust, make some absolute gifts, and actually we've minimised that AHT liability quite quickly.
Yeah, completely agree. A great example where a bit of planning can really do wonders, sort of both with the estate planning and on pensions. And on the topic of estate planning, pretty much goes hand in hand with gifting. So the next question is with regards to gifting. Obviously, you've got that £3,000 gifting allowance that a lot of people know. The commenter just asked, is that individual or is it married couple? Can one of the couple give away 3,000 and the other one give another 3,000 away? And maybe just a little bit more information on the types of gift that you can make.
Yeah, definitely. So that's an individual gifting allowance. So a couple could give £6,000 essentially. But the big sort of one that I keep sort of highlighting and trying to shine a light on, I might get a T-shirt with gifts out of surplus income on. But essentially anyone can gift 100% of their income surplus. So if they're identifying that they've got more coming in as income than they've got going out as expenditure, then they can gift 100% of that amount and it instantly falls out your estate. We've had quite a lot of people over the years who get in touch and say, I'd like to make a gift, but I'm worried that the receiving person is going to have to pay tax if I don't live for 7 years. And again, if they've got the £3,000 gifting allowance or if they've got a surplus income, they really don't have to worry about that. And in reality, if their overall assets are below the inheritance tax thresholds, it also doesn't matter if it did carry on sitting in their estate for 7 years, because if they were unlucky and they did pass away in that period, there still wouldn't be any inheritance tax to pay.
Yeah, I think the key one with gifts out of surplus income or gifts out of normal expenditure is that you need to make sure that you are tracking it and that there is a purpose to actually gift on an ongoing basis. I think if I remember correctly, there was essentially a test case on this, and although there was only one gift made before the person passed away, there was a written down intention that it was going to be an ongoing gift. And it's important as well, it is something that's claimable on death as opposed to something that's claimable when you actually do the gift. So although you might be well aware of the process that needs to be done with regards to the gifting, if your executors of your estate aren't necessarily aware of the process that's happening, that may cause some issues. And outside of that, you do have stuff like small gifts, wedding gifts that you can also give, which wedding gifts depend on sort of how close you are to the person that's getting married, and small gifts are £250 that you can give to anyone, which are outside of that £3,000 gifting allowance.
Yeah, I tend to say to people, I think there's something's happened in the past where people are really worried about gifting. And again, it comes down to that fear of tax. I tend to tell to people, well, you can gift whatever you want, as long as you're not impacting your standard of living. And then you rightly put, you want a record keeping so that your estate can be, recorded correctly. So I've been dealing with a family recently where we're actually already filling in that IHT form to say, in this year, we've had income of this, we've had expenditure of this, and this has been gifted. It feels a bit depressing to be filling in an inheritance tax form, when you're still alive. But actually, by doing that data now, that gives the executors the easiest possibility of being accurate with the data.
Yeah, I mean, I think there's probably a good time to mention sort of just general sort of estate planning basics to make things easier for your executors when you eventually do pass away. We have sort of a set of forms, or forms probably isn't the right word, like note pages for our clients, which is called sort of what I've got and where I keep it. And that's essentially just making it easy for whoever's administrating your estate, saying, I've got this much in this bank, here's the policy numbers and the contacts. I've got this much in this investment, policy numbers and contacts. And in that as well, you can put in the gifts that you're potentially making, keep it somewhere safe, potentially where your will is, so that when someone picks it up, when you do pass away, it's much easier for them to know the position that you're in, and then it's not creating a whole other level of stress, that isn't necessarily needed at that time.
Yeah, I mean, for me, that all came from, one of my family members was in ill health, was on a regular treatment, and one of the paramedics she was talking to said, what you should do is there's a special, I think it might have been Lion, but I'm not sure exactly, they almost had a little pod that you could put any medication you were on, put that in the fridge, and apparently paramedics, if they go to a house, they look in the fridge to see, okay, is there detail of what medication this person's on? It's the same sort of idea for that. If we can have all of our clients recording what they've got, where they keep it, it makes it as easy as possible for the next generation to pick it up and efficiently deal with it. I think everyone's got a fear that a family friend, might pass away and they might have money all over the place and they might lose that money and it might never really come together. And I think, that's where being able to direct people to the blueprint or the map of the financial plan is really crucial.
Yeah, exactly. So next question is not necessarily gifting, but it's potentially gifting an allowance to someone else, which is the marriage allowance. So this is a commentator on the YouTube channel where he'd like to take some of his wife's personal allowance. I presume they've already asked about that. She's got a very small pension of 4,000 and therefore doesn't need that full 12,570 available. So wants to move across that 10% to himself, who might have a larger income. Just essentially asking her on sort of the step-by-step of this is, does she contact HMRC? Does he contact HMRC as a recipient? How does that necessarily work, Matthew?
Yep. So when I've done this with clients, we typically use the paper-based form. And by doing that, you've got the ability, essentially, the person giving it away signs and the person receiving it signs, and then it gets sent across to HMRC who process it. There is also the electronic version so that both parties can do it together. But I tend to find, it's been easier for both people to sign it rather than looking at, government gateways and both of them logging on potentially to claim it with that online form.
Yeah, and just for sort of clarity, the marriage allowance you can transfer over. It's not quite 10%, but it's rounded. Essentially, it's 1,260 that's moved over to the higher earner, which essentially, when you take into account basic rate tax, it's £252 extra saving, which might not seem like much, but over the course of a number of different years, it can be. And with marriage allowance, you can also backdate it as well, a number of years, which can be helpful if maybe you listen to this podcast now and think, that might apply to me. It's not just now that you can look at it, you can actually look backwards as well.
Yeah, I think it's that every little helps approach that if you're just as tax efficient as possible, again, you get a little bit of free money, perfect. Another common question we get is when people are looking to access the pension and potentially they're not after a specific income. But a question we've had here is, how do you skim off the growth from the pension fund year on year without paying any tax?
Yeah, I mean, I think this is the age-old don't let the tax tail wag the investment dog, in the fact that you might want to be the most tax efficient with sort of taking money out tax efficiently. But if you don't necessarily need to take it out, you shouldn't then take it out. So what we've talked about here, this is what we've spoke about in a few different episodes where we've looked at sort of maybe the psychology about how do we actually start taking income from a pension without sort of feeling like we're drawing down on the investment too greatly. So that might be where you've had 10% investment growth over the course of the year. You don't necessarily need the income, but you want to just take that little bit off the top, and you can maybe use that for discretionary spend, holidays, and maybe in the years where it's gone down, you leave it in a little bit longer, and therefore wait for it to go back up. I suppose with this, there's a couple of ways to actually take it out tax efficiently. One, the most obvious would obviously be to use tax-free cash, where you can just take them out as lump sums. And that actually is another argument almost of why not to use that full 25% tax-free cash all in one go right at the start. Particularly because as you get older, you'll have more guaranteed income come in. That might be a DB pension or a state pension, which means if you were wanting to take out lump sums, that then you're getting closer to that 40% tax barrier if you're not there already. Outside of that, the only way to do it, I suppose, completely tax-free is if you're under that personal allowance. Otherwise, you will be paying some level of tax, which is why we always say you don't necessarily, or you shouldn't necessarily take money out of your pension for the sake of taking it out. But if it is something that's going to help you sort of actually spend your money a little bit more, then it's almost worth doing.
Yeah, I mean, my unpopular opinion response to this question is, if you're in decumulation, skimming off the growth is the wrong approach. Skimming off the growth is to always have the same pension across the whole of your life expectancy, where actually, is that really what you want? Most people, pensions especially, it's accumulation and then decumulation. And yes, there'll be a point where state pension kicks in and you'll be taking a lower percentage withdrawal rate and there'll be less pressure on the pension. But skimming off the growth in a negative year, what do? Are you putting more money back in? Are you taking nothing? Does that mean you're not spending anything in that year? So again, I think the psychological element of skimming off the growth might be the wrong way to think about pension planning, but it's a very common feeling, because psychologically that feels good. I'm spending free money. It goes back to the idea of spending someone else's money when you're working. And I think maybe, I often say to people, forget skimming off the growth. What do you need? What's the long-term plan? Can we be sustainable? It doesn't matter. If you have a negative growth year, I still want you to have the heating on. I still want you to pay the bills. I still want you to be putting food on the table. I don't want you to be sat in the dark waiting for some positive investment performance.
Yeah, I completely agree on that one. I think this is this skimming of growth that we spoke about is a psychological measure to try and push people to start spending. You shouldn't necessarily limit yourself to just taking that growth off to say that shortly.
Of course.
So next question that we've got is more around sort of when you've got a mix of DB pensions and DC pensions and how and when to take them.
Yeah.
So in this scenario, we've got someone contemplating whether to take their DB pension at 55 or age 60. They've got a decent sized SIP, so a flexible pension that could potentially bridge the gap between retiring at 55 and 60. But he's essentially asking sort of, if you take both, there's potentially 40% of tax. Do we take one or the other? What's the most tax efficient, Matthew? Or should you just leave the DB till 60?
It's a good question. I think it's an art, not a science when it comes to this bit. So it's all about really looking at that person's individual circumstances. If they definitely don't want to work again and they're happy that they're in retirement, then they can think about starting that DB scheme early. But it's likely to be hit with those early retirement factors. So they're going to get a lower annual income. So that's a lower annual taxable income. So that can be efficient for almost having less tax paid across the journey. But would they actually benefit more from taking flexible funds from the SIP in that early chapter up until the normal retirement age of the pension? Then they benefit from not having a reduced pension as a result of the early retirement factors. I think it's that balance, and there's probably no right or wrong answer. It's just what's right for the individual. I do like having a bit of both, having a bit of secure income and a bit of flexible income. And I think the flexible income can be used more in the early years. So that can almost go in line with what I said there, to delay starting a defined benefit pension. But it's all about the balance of how much they'll need in total and what does the wider tax position look like.
Yeah, I mean, with this one, just to know, obviously, if you are taking that flexible income and it's taxable, potentially triggering money purchase. So as you say, make sure that you are fully retired and not wanting to pay much in.
Yeah.
I was actually talking with a very similar one with a client just yesterday about this, actually, about sort of how and when to take a DB. And I kind of said, as you said, it's not necessarily a right answer either way. It's about how you feel. It turns out that if they'd have left their DB to normal retirement age, I think theirs was 65. that plus their state pension would be well in excess of the income that they necessarily needed.
Yeah.
Therefore, they were going, well, let's just take that early. Yes, I'm going to get paid less in the earlier years, but I don't need it later. I'm not going to need that much later on. And that will actually help me not draw down on my flexible pension as much in those earlier years, which will give me more sort of ad hoc lump sums that I can potentially take from later. So I think that's maybe something that you can think about. But yeah, this one's definitely not sort of the right or wrong way to do it. With this one, you're almost always gonna pay some form of tax. I think just taken away from this scenario, which can happen often, we'll sometimes have people get to 55 or 57 and say, well, I've got the option. I want to take some tax-free cash out of my DB pension, but therefore need to take that annual income and they're still working. I think that can be a little bit more of a maybe less sensible thing to do, because then you're paying tax on pension income while you're already working as well.
Yeah, I think there can be scenarios where it works. So I've had a client do that before, and they've almost gone, by starting the defined benefit pension, they'll sacrifice more of their current salary, and therefore they'll put more back into the flexible pension. So they were almost really testing the waters of seeing the guaranteed income come in. They'd reduce some hours at work, so they were almost trying to find a balance. But you're right, I don't think just turning on that extra taxable income for the sake of it adds much value. And we have had a linked question, I suppose, which is, if I've got an AVC linked to the defined benefit scheme and it's got the ability to take those AVCs as tax-free cash, does this help with the scenario? I mean, and does it allow me to have a higher percentage than the 25%, or is it still restricted by the main tax-free cash threshold of £268,275 there?
Very exact. But yeah, ABCs are a funny one because yes, they work in a similar way as flexible pensions, where you get that 25% tax-free cash, and actually a lot of the time you can take them as a normal flexible pension at retirement, and you can move them away from the DB scheme. The benefit that they really do have is if they are linked to the DB scheme, and you can essentially do something that's called commuting that pension, where in the DB scheme, you've got an option of taking a higher amount of annual income and a lower tax-free lump sum, or sometimes no tax-free lump sum, or a lower annual income and a higher amount. And essentially, you're forgoing that annual income to build up that lump sum. By commuting some or all of the ABC over, you can keep that higher level of income and have a higher tax-free lump sum. I suppose it's a bit like having your cake and eating it, where you're not really detrimented. With regards to taking it sort of higher than that 25%, obviously the question here is, can you take more than that 268,000? The answer to that, no. The essential, that's a lump sum allowance, which is the maximum that you can have from tax-free
across all pensions. Yeah,
absolutely, across all pensions. The caveat to that is if you have any legacy lifetime allowance protection, where you may be able to take higher amounts dependent on sort of if you protected yourself at that time.
And if you think, I haven't heard of lifetime allowance protection, then most likely you haven't got it. Again, it had to be an active sort of opt-in. So don't worry about that too much. One of the things I also find people get confused about is defined benefit pension and a cash equivalent transfer value, which is almost the value that the scheme's offering you to move away from the defined benefit world. People then say, why does my 25% tax-free, or why does my tax-free not match 25% of the cash equivalent transfer value? Those two figures are very different. One of them is part of your annual income from the scheme, and another one is a calculation on a day, an actuarial calculation of what the benefits might be worth to move. So there's no link between the two. So people might say, I'm confused, there isn't a 25% link. That's because the two aren't linked. So that does make sense. But again, I get people almost confused because they're presented at the same time or in a document where people say, I'm used to a 25% figure with a defined contribution pension.
Yeah, absolutely. And final question we've got today is on tax-free cash. And it's something that I think people can get quite concerned at of making a mistake when they are taking tax-free cash. And it's essentially about tax-free cash recycling. This question says that they've just been made redundant from a public sector pension at 53 and can access their DB pension when they turn 25 in 2 years' time, and was told when you access that DB pension, they're going to have to take some tax-free cash from it. There might be an automatic tax-free lump sum that comes along with it. As that, they're actually taking that as a bit of a career change and looking at starting a business and therefore contributing to a flexible pension in terms of a SIP. And therefore will be putting some money back into a pension there. They're concerned whether whether pension recycling rules would come in there and whether they'd fall foul of them, Matthew.
Yeah, so good question, and right to highlight it again. The main thing with tax-free cash recycling is people essentially aren't allowed to take pension as tax-free cash and then pay it back into a pension, get tax relief, and take it again. They're basically stopping that loop. And the key consideration and rules here are, is it pre-planned? Again, there's a decision tree to say, is it tax-free cash recycling? Is it pre-planned is one of those points. They're also looking at tax-free cash that's been taken over £7,500. And really the key bit is, has it made a material change to your level of contributions? So if your annual contributions have increased by over 30%, then you've got a risk that it is tax-free cash recycling, especially if that additional contribution was more than 30% of the tax-free cash taken. So in general, I would say to people in that scenario, check that decision tree, check those figures, make sure you're not being caught up with it. But also you could think about that the other way around. At the point when they were made redundant, there might have been funds released. That could go into a pension. Again, that could almost be avoiding the tax-free cash recycling because they put a different amount of money into it. And then when they've released the defined benefit pension tax-free cash, that could be topping up their cash balances, and that saves them from worrying too much about tax-free cash.
Yeah, I think the decision tree that they use is pretty fair in the fact that it does set out the rule sort of pretty strictly, that 7,500. It has it increased contributions by 30%. Is it more than 30% of the total tax-free cash? But then they've essentially got a catch-all on at the bottom of, has it been pre-planned?
Yeah.
If you've not intended to do it, I suppose, maliciously to try and take advantage of the rules, they can look a little bit more fairly on it, as opposed to you've accidentally done this and it's like a really big issue where you need to.
I think with this sort of thing, it's a balance. And if someone's, put in an extra £20,000 into a pension, then there's a likelihood that if that's come from tax-free cash, there's a likelihood that is recycling unless they did those contributions going forward. So again, it's a good point to raise with a professional just to check you're doing the right thing. But then almost might be a different way to do it from a planning point of view. And you'd rather, be on the right side of it rather than, worrying that, maybe that it's going to be seen as tax-free cash recycling. Maybe I wasn't entitled to the tax relief. Maybe, I'm going to end up with a negative consequence there. So definitely, we've had a few people in the past where they just have checked the figures with us. They've just said, I'm doing this. Is there anything I need to do differently? And often they are, on the right side of it, but you just want to make sure that you're not accidentally doing something.
Yeah, absolutely. So that's all the questions that we've got time for this week. As always, please feel free to put more down in the comments, or equally send us an email at retirewell@wealthofadvice.co.uk. We'll look to do another one of these episodes where we can bulk out a few of those questions in the future, but also we will try and sort of answer them every now and then in the comments. We'll be back again next week for another episode, so I look forward to seeing you then. Thank you very much.